Welcome to the Smart Property Investment Show, the podcast by investors for investors.
There you go, Phil Tarrant, host of the Smart Property Investment Show. I hope you're well. Recording in the studio, which is where I like to be. It's the natural home of the podcaster. In the dark, moody studio. We need to get a smoke machine in here, I reckon, and some fog juice. Really pump up the joint. But as you can tell, I'm much better in the studio. The marvels of the internet and particularly the COVID pandemic has forced us onto the Zoom. And that's something which enabled us to record, not miss a beat, right through COVID, helping steer this great nation and property investors understanding where and what they should be doing and how to react to that pandemic. Now, post-pandemic, and I'll call it post-pandemic, I remember sitting down with some folks in a boardroom meeting in Canberra, and those folks being some very senior people in government, some ministers, and having a long-winded debate with a whole bunch of people around the COVID and what's going to happen with it. And I think back at that point in time, this is the government that we don't have now. It's the previous government. I went, look, in 6 months' time, everyone's just going to be moved on and getting on to business. And I was pretty much right with it. So that was our sense through the COVID environment. How can we ensure that our readers, our listeners, our viewers are better informed, particularly those on the Smart Property Investment Show? And for those who are watching this on Instagram Live or on a repeat, that's what we do. We want people to make more informed investment decisions. I'm fortunate that I get to navigate this industry pretty well. I know most people who act and operate inside a property. I know the good people that act and operate inside a property. And hot tip for you, there's still some people out there who probably aren't helping you make the best decisions as in their favour rather than their own. So watch out for those sharks and charlatans. They still do exist in property, but there is some good operators out there. And much like Smart Property Investment, they've been helping people steer themselves through the COVID pandemic. One of them is not Paul Glossop, who's joining me in the studio today live. No, he is. I do mock and ingest. But Paul, it's a long way since the COVID pandemic, and there's still a huge hangover, and we're seeing it play out right now. Supply chain constraints, issues still within our sphere of influence in Indo-Pacific about getting materials and other goods and services into Australia to fight the good fight against inflation, coinciding with the war in Europe and all that sort of stuff that we chat about all the time. But the world's moved on, I like to think, in part from the COVID pandemic. And I'd give you a hot tip. Property prices have moved on since the onset of the COVID pandemic. Much like yourself, I invest in property. I have a number of assets which thankfully rode the wave of growth through COVID-19, 2 and a bit years of distress for a lot of Australians, heartache, pain and suffering, and some people's COVID experience is very different to other people's COVID experience, and I do acknowledge and mark that because it has been a tough situation for a lot of people, and there's many people still trying to come to grips with the fallout from that particular pandemic. But this is a podcast for property investors, Paul, and I think most property investors who were able to maintain, sustain, or grow their portfolio through COVID are probably happier today than what they were at the start of that COVID environment back in February and March of 2022. Now, some numbers have come out. You like to call it National Data Day. I know you get excited about this whenever these numbers are announced, because for blokes that do what you do, is very much around the harmony of the relationship between what properties have done up until this point versus what they're going to do in the future. So this is very much part of your lens to actually understand what's taken place, what's going to happen, therefore, moving forward, and whether or not you should be investing in certain asset classes. So you reckon you're pretty good. You reckon you got the numbers up in your bonds. You know what's happening. The numbers come out today. Is this correct? Which numbers are these?
So numbers came out last week, actually. But so we're
talking CoreLogic numbers, right?
CoreLogic data. So basically, rolling 12-month growth data as of February 2023 versus February 2022. But more importantly, looking at where the numbers of our 5 major capitals are now versus where they were in 2020 this time 3 years ago. So what has happened to property?
You've done an analysis on 3 years on from pretty much now, right?
Yeah.
Like February, March.
Correct.
And if I remember correctly, it would be pretty close to the day when the government shut down the borders, which was mid-March 2020, when and that was like rolling effect where they stopped flights coming out of mainland China, expanded out to Hong Kong, the rest of Asia, and then expanded out to the rest of the world. So effectively shut down aviation, going back to Yeah, DC-10s. Actually know a little bit about this, surprise, property and aviation. By the way, property is the story of COVID. Aviation is the story of COVID. So
Massively.
you go, how are you going to link aviation and property? Well,
there's a link.
I'll tell you what, aviation, I love aviation, obviously. Aviation is an immense influencer in property prices in Australia.
Absolutely.
Because they bring people into this great nation, migration, all that sort of stuff. People don't jump on boats anymore. But what we want to talk about is data today versus what data was in 2020. Maybe there's some misnomers or myths around that. Most people think property's gone backwards and is going backwards. All markets in Australia, it's probably not the case. But why does it matter? Why does data matter, Paul? I'm going to start with that.
And that's
Who
probably
cares?
that's kind of what does it mean to me? What does it mean for me or against me? To me and to other people, investors, renters, and the data. Companies like CoreLogic, SQM, some of those bigger data houses in Australia that we're privy to get access to. There's data that typically comes out on a weekly basis that's useful. Why data matters for us, on the back of the big things that have happened in the last 2 years is we've got the most recent census, which is starting to be digested, and then there's more reports coming out about what that's meant. And it's probably one of the most interesting census datas that would have ever taken place because it happened smack bang in the middle of COVID, and all of a sudden we've got all this data about tree changes, sea changes, working remotely, not working remotely, and what the really interesting part about that data will be is what has been the hangover from COVID, what's the movement back to offices such as this, when you've got a huge amount of people who were previously working into one premise now working remotely, potentially now having to come back in some way, shape or form. I don't want to go too far and wide with what the data means or why it means anything, but I think what's really interesting now is that when you look at mean reversion, so when you look at what property prices in Australia have done over a long period of time, 30, 40, 50, 60 years, it's pretty easy to get anyone who wants to go and Google what's been the average price point for freestanding established houses in Sydney or Melbourne or Perth or Brisbane or Adelaide. If you look through that data over the last 30 years, I know in my book, Plug, Surfer's Guide to Property Investing, we have...
Gloria, beep that bit out. That's old anyway, mate. It doesn't matter. That's pre-COVID.
This is the beauty of it.
Is it pre-COVID?
It was pre-COVID, and we're writing an updated version.
Of course you are.
But in saying that, I guess the reason why I talk about that is we talk about there's a very, very in-depth part about 5-year blocks of data. When you look at the average growth, almost every single major city sits somewhere between 5.9 and about 7.8% average annualized compounding growth over 30 years, 40 years. What's happened since the start, so March 2020 to March 2022? You look at any data across Australia on major cities, metro, and also regional, you would have seen that the average growth for 2 years there hovered somewhere around about 13 to 18% annualized. Obviously, well and truly over double what the normal averages will be. If you look at data over a long period of time, that mean reversion comment that we talked about and why data matters is that you've got to be realistic and say, well, over the last 30 years, we did a webcast 3 years ago, Phil, in April. I remember it, and we talked about.
You thought you had the COVID back then, I think.
Well, probably.
You were supposed to come in, but you couldn't. I remember.
I think you might have had the lurgy, or you had a sniffle, and I was like, "Well, I don't want to get the jibbers." Anyway, but I guess what we talked about then was the fact that we talked about the last 5 recessions, because right at the start, all the talk was we're going to go into a major recession, everything's going to shut down, there's going to be hell across, blood on the streets, etc. But then we talked in that actual time then about what happened over the last 5 recessions and what happened over the following 5 years to property prices. The average over that 5 years was 33, and this is go back to the brain, about 33.5% average annual growth across Australia the following 5 years in the last 5 recessions. We didn't technically... Rule of fives. But we went into a kind of maybe a technical recession early in the piece there that went back to hyperinflation, which we're now on the hangover of very quickly. Will we get into another recession? Possibly, but maybe avoided. Don't want to go into that necessarily today. But I guess the fact that what we saw was more than double annualized growth over that first 2 years, then we've seen all this inflation pressure. Now we're on the back of 10 interest rate hikes on 10 consecutive RBA meetings. Now we're seeing prices come back. And where we're seeing prices now 3 years later is going, in some markets, pretty close to that average annual growth. Some cases it's actually behind that. So we're starting to come right back to this full circle of mean reversion. So if you look at what does property do over a long period of time, somewhere between 6 and 7.5% average annual compounded growth. If you're looking at major capital cities, freestanding established houses, where are we now? In a lot of markets, we're pretty close to that. Some markets are actually less than that. Some markets have got a hangover of still more than that, and they're the markets that we can see are probably going to see a bit more of a reduction over the next 2, 3, 4 years on the back of higher inflation, higher cost of money, economy slowing, etc.
All that sort of stuff. So, and for our listeners, and for those watching us, viewing us on the YouTube or on Paul's magical Instagram device, do yourself a favour and go and check out property data and start looking for your own trends and try and draw your own parallels and conclusions to it. And a lot of the data, you can go to smartpropertyinvestment.com.au. We have free data. It's free on every suburb in Australia as indicated by CoreLogic. So it's a great resource. Put a name in, put a suburb or a postcode, whatever. It'll tell you what's going on. Now, the data points you see, and I've been doing a lot of work on this lately, so you can probably see I'm pretty connected with it for good reason, and you'll find out soon why. There's the quarterly growth. There is the annual. There's the annual growth the last 12 months. There's 3 years. There's 5 years, and there's 10-year average annual. So 10-year average annual over a 10-year period. What has been the average annual growth? Good indicator of long-term predictability of house price growth. Your 5-year and then your 3-year. Now it's really funny. You're seeing a lot at the moment. 3-year growth is a lot higher than 5-year growth. So really indicator, you can see how suburbs have performed over the COVID period, which we're talking about. So that 3-year growth now largely is coming in, there's probably still a couple of months of hangover pre-COVID in those data coming through. So I think the last set was as of the back end of last year, right? The full capture of December 2022, right? But look for those suburbs where you see high 3-year, a lot higher than 5-year growth. So it means you're still in the ascendancy. And if you're still seeing positive average annual growth, and you're still seeing, if you see positive 12-month growth and positive 3-month growth, you can start drawing a lot of parallels between all that sort of stuff. And that's what you and your team do, I would imagine.
Absolutely. And you worked forwards, and the way we work would be backwards, is that you consistently, properties, and there's probably 2 ways I'm going to dissect this, is that if you're buying property for a 12-month outcome, it's a very difficult proposition because of the way that property is structured in Australia. Your taxes essentially inhibit you to be able to trade property within a 12-month period effectively, unless you're getting circa 15-20% growth or more, because it just starts to become too cost prohibitive from an upfront cost and exit cost perspective. However, it's a really good way for you to understand how do you assess where I might be able to build in some equity into my portfolio quicker than if I was just to buy the vanilla tried and trusted property that's next door in a market they already know. So to your point, Phil, if the market's growing on a quarterly basis and then on an annualized basis and on a 3-year basis, and potentially that's ahead of what the 5-year or the 10-year curve was, you're probably talking, if you're looking at the bell curve or the hockey stick, you're probably saying, well, it was slower, faster. And if you're buying at a point where it's slightly faster than what it has been over the last 10 years, property is a very slow train, a very hard train to slow down, rather. It's essentially turning the Titanic. So if you're trying to really think, oh, hang on a second, it's going to stop, property does not stop. Property, via inertia, gets to a point where it gets there, and slowly transitions to the opposite way, and the other way around as well. It doesn't start growing overnight. It's very hard to do that. And we kind of only had a really unique circumstance where we had the ability to cut rates effectively very, very quickly on successive periods to then stimulate it quickly. But we've had the ability to do the opposite, which we've just experienced over the last year, where rates go up and we can stall markets very quickly if we do need to manipulate it. But the interesting part to that is if there are markets now that are still growing in the back of or in the wake of 10 successive interest rate hikes, it tells you a fair bit about what's under the bonnet of that actual property market. There's got to be some underlying strengths on cash flow, on disposable income, on lack of supply, if markets are still growing on the back of basically our fastest interest rate hikes on record.
So there's a lot there, Paul, and the key thing is that markets don't move linearly, in a linear fashion. They go up and down. So it's about timing. To the point also, most property data is sort of capped at 10 years based on what you find openly. So if you really want to go and look at long-term trends, you've got to go back. Now, here's the thing, is a challenge for our listeners on Smart Property Investment. Let's see who's good at this. Go and have a look at the Smart Property Investment data and see how many suburbs you can find that have negative 10-year average annual growth. See if you can find anything in the red out there. Do you reckon there's many?
I think if you probably even refine that further to say populations with more than 20,000.
Yep. Okay.
Negative 10-year growth, total 10-year growth.
Yeah.
I'm happy for someone to show us where and what it is.
Okay. If you put
I
your
couldn't
money,
tell you.
all right. If you can find one of them, Paul Glossop will shout you a fancy lunch, probably lunch at Kingsley Steakhouse.
How about we get him on the podcast and we'll talk about it, and maybe we'll dissect that particular market. If there is one out there, I'll do a deep dive into it with my team. We'll say, well, here's why that particular market potentially went backwards, and we can dissect it, and maybe we'll go down to the local Vietnamese kitchen and get a bun mai.
I do like a. Yes,
Mm-hmm.
that's pretty good. So there's a challenge for our listeners on the Smart Property Investment Show and the Property Investment Podcast Network. I'm going to have a chat with Paul Glossop now. I'm conscious, Paul, we got straight stuck into it. That's Paul Glossop from Pure Property Investment. Maybe you need a little bit more structure to this podcast. When we come back, we'll do that. Back in a moment. Welcome back, everyone. It's Phil Tarrant. I'm the host of the Smart Property Investment Show. I hope you like that advertising break. I have no idea who you listen to right there, but a big shout out to all of our supporters across the property investment sector. Now, Paul Glossop, Pure Property Investment, you've already got a plug in for your book. You've already got a plug in the fact that you're going to re-release it at some point. How different is it going to be?
Well, it's going to be post-pandemic. So, talking about, what happens in the wake of hysteria and unforeseen, unpredictable changes.
So the point of this particular podcast is to go through the numbers that have recently come out. Happens every month. And hot tip for everyone, don't get too absorbed with property data. It'll do your head in eventually. There's a lot of good clues. There's trends. There's some ways in which you can leverage property data, but don't think it's a panacea for all your property investment decision making. Number one, it's old. Number two, it looks backwards rather than forwards. And number three, if you sit around and wait for the perfect moment you identify through property data, guess what? You probably missed it. So important, but it's not one and the same of a holistic view to investing in property. And guys like Paul and his team at Pure Property Investment and the cohort of very good buyers agents we have in Australia sort of do this for you, right? That's why they do it. Hence the reason why it's a growing part of it. It's really funny, Paul. I've been thinking about it. Sort of a bit off topic, but connected. Mortgage brokers now account for 70% of all mortgage origination in Australia. So mortgages in Australia, which is huge, right? Mm-hmm. So 7 in 10 Australians choose to use a mortgage broker. What's that number for property investors? Because buyers agents, because I reckon there's something in buyers agents. We've backed it for a decade, right? Yep. The lion's share of properties I've got, I've secured through a buyer's agent, investment properties, and I've been, very detailed on the reasons why. I'm not going to go over that today, but essentially it's an enabler for me. Mm-hmm. What percentage? Give me a percentage, because no one knows. A mystery.
And this is the data part that is quite difficult, isn't it? Because there's only not all states require buyer's agents' details to be part of a contract of sale. So if you really sort of say, look, realistically, where does that data come from? Well, the data would come from contract of sale lodged, and on New South Wales standard contracts of sale for residential, now there is a section for a buyer's agent. Yeah. 10 years ago, that section didn't exist. No. So that section is actually there now. So what I think personally is that we're going to need another 5 years of transactions to get some actual compiled data. But I mean, if we look at the amount of buyer's agents who are representing buyers in the transaction process now, truly representing the buyer for established property across Australia, whether it's owner, occupier, or investment, the buyer's agent space has probably 100x, I would say, comfortably in the last 10 years.
It's gone from 1 to 100, has it?
Well, it's gone from probably 100 to potentially 10,000.
Sort of. And you're talking about established properties, and that's a really important point. So you're not talking about project marketers. You're talking about
actual traditional buyer's agents who aren't marketeers, who don't have a brochure to try and sell something which they're going to kick back from someone down the track. Yeah. That space, I wouldn't be surprised if you and I are having this same conversation in a decade's time, and we're representing a huge, and I expect it could potentially be a huge portion of all transactions. When you're talking 500,000 transactions a year in Australia, I wouldn't be surprised if it starts to represent a good 100,000 of those. Now, what will happen invariably is if it does go down that pathway, is you will get potentially, and I think realistically, you're going to get the aspect of what the mortgage brokerage space has faced quite heavily over the last 10 years, which is bureaucracy and scrutiny. Yeah. And that's a challenge. Because
it's really tough, right? And the difference with mortgage brokers is that the consumer pays, the buyer pays the buyer's agent, whereas in mortgage broking, a commission is paid by the lender, which is a really effective way to actually remunerate mortgage brokers for the important work that they do. But mortgage brokers need to act and operate under best interest duties and all this sort of stuff, right? Probably buyer's agents side of things in property investment is sort of largely unregulated. It's sort of self-policed. I think on the board of
Pippa,
which
you have previously been.
I have been Property Investment Professional Australia. So this was a sort of self-policing mechanism for trying to champion best practice inside of buyers agent. But it's a pretty collegiate industry. Like, you guys don't walk past each other in the street and sort of, or put bananas in each other's exhaust pipe because you're worried about someone skewing work. Yeah, you know what I mean? Like,
I'm sure it's happened out there somewhere.
But by and large, the buyers agents, like, you're all collectively sort of within the same sector, right? And you're all trying to grow it. So it's not
completely.
You're growing the pie rather than...
The pie is enormous. And I think anyone who thinks it's a dog-eat-dog has got the completely wrong mindset. The lion's share of the opportunity is not even been touched yet. Yeah. So the reality is that the job that we have as buyers agents, and my role on the education side of things on the board of Pippa, is predominantly, to your point, mate, is to champion the use of what a buyer's agent should and could be doing for the consumer to ensure that they're better informed, similar to Momentum Media's whole platform, so we want buyers to be better informed to make better decisions on buying property correctly. It's not that complicated. We charge a fee for service, and that fee should be justified in the process, both the price and the outcome and the education that comes with it. Beyond that, ultimately it's still the consumer's choice or the investor's choice or the owner-occupier's choice to sign that contract of sale, as long as all the information that's presented to them is done to the best way. And our job is to avoid people making enormous mistakes where possible. Yeah,
and it's, everyone wins in that basis. And we obviously talk about buyers agents within the context of property investment, but it's a growing area inside of owner-occupier stuff. A lot of people use buyer's agent to find their principal residence, their dream homes.
Yep, so do we.
Which is a different brief, right?
Completely different brief. And it's a far bigger pool, If we talk about a third of properties are investments and the 2/3 are owner-occupier. So it's a big pool, and it's a big representation and the big decisions. Yeah. Big money at stake.
Yeah. So we're talking about property data, right? And for those who are watching this on Instagram, you would have seen live the brief I got from Paul.
National Property Day.
Property
Data Day.
Probably, you love it. This is it. Have you got a jingle yet?
No.
You wake up in the morning and go,
but I reckon we need to mark down this date. What is the date today? We'll mark it.
14th, 15th.
We're going to coin it. I don't care. I reckon CoreLogic will jump onto this. We'll get them to sponsor this episode once a year, and we'll maybe bring Tim Lawless in here and do it. Love it.
We could do, and we're also sponsored today by our good friends at Schweppes.
Effervescence.
With the infused natural mineral water with a hint of lime. For any property investing executives at Schweppes, we do like this stuff.
Delicious.
Tasty and healthy. No sugar.
Sure.
All carbohydrates.
Full fructose.
There's a lot of carbohydrates in property data, right? It's making people fat if they're not burning it and using it.
It's a waste.
It's a waste.
Empty calories.
So back to it. So we're talking about property data, right?
Yep.
So the question is, how much has it moved since pre-pandemic to... I'll use it post-pandemic because it's sort of not post-pandemic.
No,
yet.
It's hangover still.
Yeah, we're in the sunset. We're in the sunset of the pandemic period. Has it gone up a lot?
Yeah, mate, I think if I take the biggest 5 markets, so we look through Sydney, we look through Brisbane, we look through Melbourne, we look through Perth, and we look through Adelaide. There are 5 biggest markets. There's a few other markets in there, be it Hobart, Canberra. They have data. The data is there, but it's probably represents a much, much smaller portion of all buyers. If I look through and we talk about 3-year data, and this goes back to, don't get too bogged down with what I'm going to say on the numbers here, because again, this is 3-year data. This isn't 5-year, 10-year, 12-month, 3-month. It's 3-year data. Draw your conclusions from this, what you want, but knowing, going back to what we said earlier, average 10-year growth sits somewhere between 6 and almost 8%, depending on which city you're looking at. So it's pretty consistent.
So just to be clear, the data we're talking about is the December 2022 numbers that have come out.
February 2023.
February 2023.
2023, as of the total growth between then and February 2020.
Okay.
So 3 years, basically. Where do property prices in Sydney sit now versus where they sat in February 2020?
Yeah. Okay.
Yeah. So I'll break it down and I'll go through these numbers. And I'm not going to go through suburbs and LGAs and catchments and different zoning, etc., because there's obviously going to be variations. But there's enough transactions to get the averages pretty much smack bang anyway. So this isn't going to be fictitious data, or it's going to be skewed by a big waterfront sale or something else. It's pretty going to be pretty accurate. But if I start on the East Coast, Brisbane, as of February 2023 versus 3 years prior, is still sitting at around about 29% above where it was 3 years prior. Now, noting that that market has actually come off 10% in the last 12 months. So obviously you draw that conclusion, February 2022 versus February 2020, it was almost 40% up on that time. And Phil, you have a lot of property in the Brisbane market. I personally own property in the Brisbane market. I did a lot of equity extractions last year, refis, revals, etc. Strike while the iron's hot. Hot tip for anyone who's looking to finance. Make sure you get finance and revals when you can. Don't wait for a cycle to end because you might be burnt like you might be right now.
Yeah.
So Brisbane, basically.
To counter that argument, if you pulled out money at 80% based on a val from February 2022, you're not going to be in negative equity, but you might be knocking on the door of it.
Yeah, absolutely. And that's if you spend it, obviously. If you spend it. And then also on top of that, if you spend it and you spent it, let's say, on an investment, and that investment wasn't yielding you a return that was cash flowed enough for you to be able to hold it, that's where the risks come into the fold, right? Yeah, cool. And this is where modelling out, can you afford it? It's not just can you afford the actual deposit. Can you afford to hold a property for a particular period of time with negative rates? And that's a different conversation altogether. But it's a very valid point that taking equity out is great. But if you take it out and then the market retracts, you got to be comfortable. And this is obviously where banks do their valuations somewhat with a conservative lens for these reasons.
Yeah. Okay. Sorry to interrupt you there.
That's okay. So 29% above where it was 3 years ago on the back of 10% reduction in the last 12 months as well. So still a very, very good outcome for anyone who owns assets across Southeast Queensland in general. Going down towards Sydney, and this might surprise a lot of people, but Sydney sits at the moment about 8% above where it did 3 years ago. 8%. Going back to our long-term data, 10-year data, average annual growth, 6 to 7.
So it's about normalised.
Below. It's probably slightly below. But if you look at it,
does that mean you should invest in Sydney? Quick, hurry up!
Yeah. Quick now, news should have bought yesterday.
Quick! Refinance.
Yeah, absolutely, if you can. But again, it's a very interesting one. Now, obviously, Sydney's seen, depending on what data you look at, anywhere between 13 and up to 16% average metro market reduction in value over the last 12 months. Yeah. Some markets are more than that. Typically, the higher price markets have dropped more than that. The lower price markets have dropped less than that. The median or the average is somewhere between that 13 and 14% reduction in value as of the last 12 months. Interestingly, anyone who's followed that CoreLogic data would have seen that February this year rather, saw the first sign of growth in 12 months in Sydney. Now, people might be saying, well, hang on a second, it's time to strike. Maybe it is, but I guess what's probably pretty obvious is that it's not an absurdly expensive market compared to where it was 3 years ago. If you're looking at just the price,
the median's under $1 million for Sydney. It come back.
It's close.
It's close.
It's
right?
close. Yeah.
It got up there though.
I think we're tracking 1.3, 1.4 at one stage.
What's it come back? Sorry, what's property come back in a year from
about 14%?
14%.
Yeah, in 12 months.
That's all of Sydney, right?
All of Sydney. Yeah.
So some places have still grown in that time.
I would assume
it's soft,
flattish. Yeah, flattish, and you're typically finding that you go from affordable to middle to blue chip corridors. You're finding that the ripple effect works reverse on that front. So the blue chip markets have suffered the most. The affordable corridors suffered the least.
Yeah.
Is that going to be a consistent theme? It'll probably find its way through some metamorphosis over the next 12 to 13 months. I think
property metamorphosis.
Yeah, potentially. And I think
that's a caterpillar becoming a butterfly, correct?
A chrysalis.
A chrysalis
before the butterfly. But there is that to really consider. But I think overall, if you're looking at just purely data, 3 years, 8%. Would you be happy in your portfolio 3 years, 8%? Look, it's probably slightly
the argument would be your money would be working better for you somewhere else. And to your point, it would have been in Brisbane.
Straight away there. There's an obvious one. Yeah, correct.
Yeah. And this is the logic, the ongoing logic of like, you see it all the time and, buyers agents do their thing. And I speak to most of them and also property investors, be like, and back to property data, they'd be like, I reckon this place is going to be good to invest in. I'll look at the data and I've gone, yes, I've proven that as a good place to invest in, this sort of bias that people have. What most people will say, yeah, it might be a good place to invest in, but is it the best place to invest in for the purpose of deploying your capital so you get the best outcome that you want? And for most property investors, initially, it's around capital growth.
Yep.
So this is what Paul's talking about right now, is like, where can you stick your money, irrespective of any bias you have, to perform best for you for a period of time? It doesn't need to be forever. You know, it might be 2-3 years. You're going to park my money there for 3 years. I might not want to be there forever, but I'm going to chuck it there for 3 years. It's more transactional investing, and then I'll deploy it somewhere else in time, or it's a long-term play on it. So this is the important bit. So you would have got 8% in Sydney, to your point. It went up, come down. Grand old Duke of York investing. But your money probably would have performed better elsewhere. Now, you're probably going to tell us where that is, right? Because you've got some other capitals.
Yeah, absolutely. And I think this is the key part is don't take what I'm going to say saying, well, the markets that have done the best, they're the ones that you probably should invest in now. It probably gives you, to your point earlier, Phil, it gives you probably Jahari's window of where you probably should have invested in 3 years ago if you wanted that investment return now.
Jahari's window. Where did you pull that out of?
My previous life in different vocations, mate. Yeah. It comes out certain ways and in other ways. But
if we can explain Jahari's window,
not right now. Okay. We'll go through that another time. I think we get far too sidetracked. Yeah. Anyone who's listening will probably. There's some people who are in the corporate world. Now. You'll get it. But if we go further down the East Coast, Melbourne, and this one will be interesting to a lot of people because there'll be no doubt a lot of listeners here are based or have some exposure in Melbourne. Melbourne, for the best part of the last 3 years, flat, plus minus a couple of percent. It's pretty obvious when you start to understand what's happened over the last 3 years why Melbourne is flat. Because it was probably the most affected major market in Australia throughout the whole COVID outbreak and the lockdowns and how the pandemic essentially affected that market. Migration absolutely obviously affects that market more than any other market across Australia. One would argue that the rental market there is starting to really benefit now, but it's a historically low-yielding market anyway. So is it better? Yeah, it's better than what it was, but is it better than other markets if you look at it nationally? Probably not. But if you're sort of comparing, if you put $1 million in the Melbourne market this time 3 years ago and you look at it now, it's probably worth $1 million minus your expenses to get in there, which is probably 5%.
So you've burned a bit of dough.
Yeah. Your opportunity costs would be relative. If you looked at the same $1 million in the Brizzy market, you've made 300.
And this goes back to the point about where do you deploy your capital?
Opportunity cost. Yep, exactly. Yep. And now, again, this isn't to say that the next 3 years will be the same for Melbourne, but it's probably to say, well, starting to look at what you talk about, Phil, is that where do you find the inertia of what's going to happen in the next 12 months, 24 months, 36 months? Melbourne certainly hasn't been a great market. And I wouldn't
say that a good thing or is that a bad thing?
Yeah. If you're an owner-occupier and you're cashed up, for me, Melbourne's probably going to be the best opportunity that a lot of people would have seen to buy a home in the last 5 years there. Does that mean that property is going to skyrocket in value? I think the jury's well and truly out because I don't see much data.
But it sort of doesn't matter if you're a place to live. But if you're a property investor, you want to leverage capital growth in your principal place residence, which, by the way, is a great enabler for property investment to refinance and pull that equity out. Like that might be a handbrake on your property investment.
Yeah, absolutely. And typically it is. It's usually, if you look at property investment data and mortgage data, it's usually the number one way that someone gets into their investment is buying their home, leveraging the equity and going from there. Now, if that property doesn't go up in value, you don't have that opportunity. So to your point, Phil, it is, as much as people think, I'm going to buy a home, so it doesn't really matter. Well, it depends on what you want to do with that home at some stage. It probably matters an awful lot.
Yeah.
Renting might still be a far better option. But so there you go. Melbourne, flat. The last 3 years, start of the pandemic to now, flat. And it probably then start to, we've just gone through the biggest markets, the biggest three markets in Australia. And you start to consider, okay, well, the media is gone into overdrive on property markets are basically, they've gone exponential, they've tanked, et cetera, et cetera. If you start to look at those three markets and average them out, you've got 0%, 8%, 29%. Draw the conclusion of those three markets, you're probably hovering somewhere between 10 and 15%. Go to 3 years, average annual growth,
there you go.
6-7%. If you pick one property in each of those three markets, what would you achieve? Probably about the average. Now that's where those big three markets sit. Now this is where it gets interesting. You go towards Adelaide.
Well, hang on. Well, so you want to go to the non-major markets?
Well, this is still part of your five largest.
Okay. Well, we're going to jump in there and we're going to take another break, Paul. And when we come back, we'll work out what's going on in Radelaide. What's a good name for Perth? What do they call that?
We'll come back to it.
Something or other, and probably Hobart, I imagine you're going to talk about, because Paul loves talking about Tasmania. Yawn. #yawn. Back in a moment. Welcome back. Phil Tarrant from Smart Property Investment. Hope you're well, with Paul Glossop, CEO of Pure Property Investment. Adelaide. So
the
little engine that could.
Yeah, that's pretty much it. I mean, I think, mate, you and I used to sit on the board of Pippo, going back to that, with Peter Kalitsos, who's a property professor out of Adelaide. And that he is highly leveraged in the Adelaide market, and he does champion it a fair bit. But he's also quite a realist. And talking with him as an investor in that market over the last 30 years, he will openly tell you that it is always the market that lags every other market. Other markets have to have an absolute tear before things go well in Adelaide. And that's kind of what happened in Adelaide. And Adelaide was probably the last market to really catch on fire when it comes down to property growth throughout the actual pandemic. The reality, though, is that it went hard and it went fast and it went for a long time.
Yeah.
And really it was on the back of out of ordinary interstate migration. It wasn't overseas migration, but it was pressure from interstate migration coupled with no supply, coupled with price points that were pretty affordable. Pretty standard things when you look at what moves property prices. But at the moment, Adelaide is only just starting to come back from its peak. Now, when we talk about its peak was probably pretty close to 50% up on where it was 3 years prior. Right now, it's just a bit above 40% on where it was as an average as of 3 years ago. So if you park that same million in Adelaide, you're averaging about a 40% return. And the yields in that time were pretty good as well. You're sort of circa 4 to 5% throughout that whole time. If you got your money earlier in the pandemic, you probably got your money at 2 or 3%. And you're probably neutrally / positively geared on that same asset. So a fantastic outcome. Does that mean that outcome is going to repeat in the next 3 years? I will again go on record to buy someone lunch if they can show me the data in 3 years' time and say it was the number one performing market. I highly doubt it. Highly, highly doubt it.
So Adelaide is it's an interesting market because a number of reasons. It was the birth of the nation and Australia. It's the only capital that never had sort of convicts. Number one, big migrant.
Explains
community.
the accent.
Explains the accent. Big migrant community from early days, which helps support viticulture. But only today, Paul. Here we go. I'll put you on the spot. This is for our Instagram Live people to know how current this is. A lot of the noise around Adelaide is driven by it being a hub of economic growth, whether that's out of the mining industry or the defence industry. Only today, they've just made this new announcement around the submarine program. Obviously, been telegraphed. We knew what was going on for quite some time. But Australia to get nuclear power subs, it's going to get 3 from America, maybe 5 as an interim gap until we start building submarines off a UK design. So the UK and the Aussie are going to get the same boat, essentially. Similar combat system, and they're going to build some of them. And it's probably going to happen in Adelaide. So people are going, quick. They reckon it's going to be 20,000 jobs created over it. I think the program's worth about $300 to $400 billion, right? Like, that's big bananas, yeah? Is that good for Adelaide? Is that going to make any difference to property prices? It's just another headline announcement. By the way, this is in 2040, right? You know, it's a long, long way away. But people here, they read the front page of the paper or they read it somewhere and go, quick, I better hurry up and get in Adelaide. Like, this is really contextual because it's happening as we speak right now. And whether it's Olympic Games in Brisbane, whether it's a new brewery in Hobart or Badgerys Creek or whatever it is, right? People get so absorbed and obsessed by these big economic headline announcements around job creation, job growth, industry growth and development, like long-term continuity, like these submarines, right? They're going to take a long time to build it and they need to be fixed and stuff, right? It's huge. Our grandkids will be serving on these boats, right? You know, it's a long, long time. Doesn't matter. And we talk about Adelaide.
Yeah, I'll throw it back to you, Phil, and this is probably a question for your defence knowledge. What happened to the previous, where the existing, is it the Collins class were getting constructed in Adelaide? And that's been, is that been wound up?
Deep level servicing for the Collins class submarine was happening in Adelaide. And then when they announced the old sub announcement, when we're going to build some stuff, we're going to build some French stuff, they said they'll do deep service maintenance out in Western Australia. Right? You know,
and what happened to that is my question.
Well, we all know that the famous sub deal went poo-poo. It's a French term. And we had a falling out with our French friends over
Sarkozy at the time.
And they started blocking other imports into France. So it was a bit of a diplomatic fallout, right? And there was compensation paid to the French and stuff. French are used to getting compensation. Sorry, to our French friends, we like the French.
And we do love the French. I have. So actually, some very good French people who work in our company, and they're excellent cooks, by the way. That literally, one of them is a Michelin star chef.
What?
Yeah.
Really?
Yeah, we'll get him in here one time. We'll get Gerald in. I think he's actually working on a purchase for a colleague of yours at the moment.
Oh, okay.
Sidetrack.
I didn't know that.
Yeah.
So, okay, well, maybe we can cook for a prize. You got to find out that. Anyway, so these announcements changed and drift around with the wind.
Yep.
Right. So, and my point is, you go, man, that's massive. Like this thing's like 1% of GDP, right?
Yeah.
It's just huge. It's a lot of money, right? And we're to pay for it over time, and it's good for the nation, all that sort of stuff. But the point being, these announcements get made all the time, and they're never really set in stone. It's like it's an intent thing. And look, I would like to think that it's such a significant undertaking by the Australian government, and there's continuity. Whoever's in power, whether it's the coalition government, Labor government, they're like, this is important stuff. We need this for a deterrent to support the security environment and the fractured security environment we operate within right now. But to quickly jump out there and go, I'm going to buy some Adelaide property because we've already built the shipyard to build this stuff is already underway, and it needs to get ready pretty quickly. So there's good continuity, and Adelaide will struggle with a workforce, so they're going to have to work really, really hard. And I imagine that the state government down there is already going, we got to get more people to move to Adelaide.
Yep.
Right? How do you do that?
Yep.
Good place to live. But, that must be good for property investment. So it's easier to draw these parallels if you have a bias of going, I have an idea.
Yeah.
This is happening, so I'm going to buy a property there. I'm going to prove all the reasons why. But to counter your point, you're pretty much going, in 3 years' time, I reckon.
Yeah, it's a really good point, Phil. It's a really good point because I think that this goes back down to what we talked about a fair bit on this podcast is confirmation bias. Is that you think, okay, there's hundreds of billions of dollars on the line for 20 years, long-term contracts, lots of jobs and high-paying jobs consistent into a concentrated period. That should mean something positive for property. Look, over the long term, it's not going to be a negative necessarily, but you've got to take it into context to say, well, what's happened in that market in the last 3 years? And we just walked through the data. That market grew to approximately 50%. It's probably more like early 40% now. And it's seen probably what it would have got over the last 8 to 10 years in the last condensed 2.5 years as far as growth is concerned. Now, does that market have the propensity to do another 50% in the next 5 years, let alone the next 2 years?
And you're saying no way.
You can't just think that because, and it's not necessarily going to be, okay, well, maybe an area 5 kilometres from where the shipyard is that you'll get this concentrated level of growth because people essentially buy from what they can afford. And if they think, oh, hang on, that's too expensive, I'll go to the next suburb, ripple effect, so on and so forth. But that is what you really need to consider. It's still a small market. It's still a million population. Considering that versus Perth is more than 2 million, Brisbane more than 2 million, Sydney, Melbourne, more than 6 million. You're talking about these markets are far more diverse. They don't just run off one announcement and one industry. They run off a multitude of different things, and they have done so for decades and decades and decades. So I think to that point, is that going to affect the market immediately? Highly doubt it. Is it going to affect the market en masse? Highly doubt it. Is it going to be a positive change long term? Yeah, look, it's going to have an industry impact, similar to what other announcements come on other areas, but it's still highly concentrated and it's still a very long product that has to get delivered.
One thing I could probably say is a first. This is probably the first time, and this is for our Instagram live viewers, where someone's actually talking about the new submarine deal and what it means for Adelaide property. There you go.
Happiest day of the year.
Right on point. Right on point. No, God. Anyway. Yeah, so just take a measured approach to these announcements and stuff, and don't subscribe to it. You see it all the time, and depending on who's selling what at any given time, right?
100%.
I'm sure there's some developer there trying to develop a new 300 apartment complex somewhere nice on the beach down there, going, isn't this a good look? Look at this investment into this is why you should buy.
Anchored by the huge government contract for subs.
Yeah. So again, it comes down to, I'm sure Adelaide's going to be a good place to invest over the long term. It always has been, always will be. But is it the place where you want to put your money today?
Correct.
Depending where you are in your cycle. Now, I know you're going to want to talk about it because you love it. I reckon Tasmania has done its run. It's done its hullas. It's finished. There's no more there. Then you're not going to get any. It can't sustain the growth it's been having.
I would personally say I completely agree with you. And I think it's probably anyone who thinks they're going to get a great 5 or 10 year return from now to the end of this decade. I think there's going to be at least a dozen other major markets of more population than Hobart as a specific city than what it's going to do. It's had a phenomenal run.
By the way, nice place to live.
Phenomenal in general. But it's ironic, right? People basically didn't figure that out until about 6 years ago. And this was pre-COVID, by the way. We've talked about Hobart, we've talked about Launceston, Devonport, Burnie. I've personally gone to all those markets. We've bought hundreds of properties in those areas. And I think from memory, Simon Presley was another, shout out to another good buyer's agent who does a lot of data, a lot of digging and a lot of research, good operator. But I remember running into him at Hobart Airport.
Did you have a banana to put into his fighting for the same
property?
property?
Literally ran into him as the old shoulder joust, and we gave each other a look and continued on. But it's funny because you go back, like that was almost 10 years ago.
That's crazy.
Like almost 10 years ago we started buying there. We bought there for about a 3-year period, and those properties, all of them have doubled. Everything would have doubled.
But the point being, and Simon is a very good buyer's agent.
Yep.
He's I've had him on the show a lot, and if you listen to this, Simon, I hope you're well, mate. You had to be there at the right time.
Yeah.
So if you were there and you've had this sort of accelerated 10-year, happy days. Now the point is, is your capital working for you where you're at? And it's going to depend where you're going with your portfolio and stuff.
Correct.
But is it worth selling down there and realising that gain and parking that capital somewhere else?
Yeah.
That's what the smart investors are doing.
And this is a really interesting one. This probably focuses more, and we'll talk about some data continuing on that in a second, but this probably more talks about investors who have held for a relatively decent period of time. So if we go back to an investor, and I can pick dozens of them, but if I pick one in my mind who I know we bought an asset for in Glenorchy, it was about a $210,000 purchase. At the time, it was about an 8.5% yield, it was about $400 a week rent. That same property is now worth about circa $520, $550. And the reason why I know that is I did a portfolio review a couple of weeks ago. Rent's now north of $500 a week. On purchase price, north of 10% yield. They have the option, right? Like right now you say, is that market going to double again the next 10 years? My personal position, highly doubtful. Is it going to outperform other markets? Highly doubtful. But what is all the work is done. You've broken the back of what you need to get out of assets. You've got growth, you've got good cash flow. Do you need to sell it? Do you need to sell it in a market that's actually seen some pretty heavy retracing in value, and you have to essentially sell it for 10% less than what it was probably worth 8 months ago? Well, an argument could say, hey, go get a bank valuation, even if it's super conservative, and it comes off, give you 30, 40, 50 grand less than what it is actually worth to sell on the day. Let's say a 450. The debt on that property was about 170 grand. He hasn't touched it, had a 10% deposit, closing costs. He can borrow 200 grand on that property in equity, and it's still cash flow neutral.
Yeah.
It's still neutral. So if he took 200 grand, took his loan from 170 to 370, it's a mid $550 a week rent. It's still going to stack up at a 6% interest rate, cash flow neutral plus an equity extraction. So your question comes, do you sell and pay tax, or do you extract equity, pay no tax, still be cash flow neutral, deploy that money elsewhere, play the next long game? This is the conversation.
That's the difference between a buyer's agent that finds your property versus a property strategist, right?
Yeah.
Who has sophistication. And if you're using a buyer's agent, that's the sort of what you want to be looking out for, is people who can actually understand this notion of not the transactional finding of a property. That might be okay for an owner-occupier. It's just like, find me my dream home. I want to raise children there. Needs a flat lawn and the pool and all that sort of stuff, versus the strategic and the tactical components of building a property portfolio.
Yep.
And make sure your buyer's agent is also a property investor would be a hot tip for me. Okay, so that's by the way. Sorry, that's Hobart. I like Hobart. Tassie's cool.
Yep.
It's done its run. So that's okay, right? If you've got property there, hold it, do whatever you want with it. But as a property investor, thinking about where you should be investing today, with a hindsight of 3 years of property data since the COVID pandemic, I'm sure you're going to come out and say Perth's the place to be.
Well, I'll walk through the data. I mean, whether people think it's a place to be or not, they make their own decision. But if we go back to where it was and where it is now, 3 years on, we're about 23, 24% above where it was 3 years ago. That's a good return.
Yeah. Good
return, 8% a year, give or take, over that time, excluding yield, which is probably best in the country for a major metro market. Where it becomes more interesting, though, and I think you touched on this a lot at the start, Phil, and we're probably going to go through this in the next few weeks and months, is that we've got some really exciting stuff around this, is probably talking about what's going to happen over the next 12 months. And you sort of then take that snapshot. We talked about 3 years, 24% growth. What's it done in the last quarter? What's it done in the last 12 months? What's it done in the last 3 years? We just talked about what's it done in the last 5 years, 10 years. And you start to realize that many of those markets have had a big ramp up. But there's only a couple of markets that have had the opposite.
Mate, I reckon, go and dig around, have some fun on WA suburbs. Go and look at the 5-year growth and 10-year growth on this stuff, and you might see some reds still. You're going to start seeing greens in the 3 month and 12 month. It was certainly a period of lackluster.
very much
growth
so.
in the Perth market? Because it was pretty much pegged very similar to what was happening in Sydney way back when.
Yeah, 2007,
ago.
pretty close to on par with average price points,
Yeah.
which is wild to think. 15 years ago, you spend the same amount of money, you get the same product in Sydney as you do in Perth. Half the size market. It obviously went through a rampant boom.
So you're seeing buyers agents in Perth Airport as well? You're sort of making sure their bag gets lost.
It's a relatively similar story where we were there 2000. We've been doing some reviews, mate. We've been buying some assets in Perth since 2019. It's almost 4 years ago now. Since we were buying the first assets, and our job is not to buy when the market's done its best part of the 5-year growth. Our job is to get into markets when they make sense at a point in time. And I'm not saying that Perth makes sense for everyone. I'm certainly not saying that we're only buying in Perth because we're buying in other markets. I personally signed a contract for a property today in Sydney, but it comes down to the circumstances and what you're trying to achieve. That being said, if we're looking at really what's happening in the Perth market, and to your point, mate, if we're just talking about data, the data will suggest that the last 12 months, we've seen 10 interest rate rises, and we've seen the hardest environment for someone to find finance that we've seen on record. In the wake of that, Perth's basically been neutral. In the last 3 years, Perth's up 24%. Perth still has pretty much the lowest vacancy rate of any major metro market in Australia. It has essentially the highest level of rental growth of any freestanding houses versus purchase price on a yield perspective. So your cash flow is actually still relatively neutral. A lot of those fundamental aspects of how do you hold property for 10 years are ticking the boxes, where it sits from an average annual income versus average annual mortgage commitment rates versus things like actual supply versus things like international as well as domestic migration versus where the unemployment rate sits. We tick off all those boxes. It's a market that probably looks better now than it did at the start of the pandemic, even though it's probably seen 24% growth in that time. And if you compare it to other markets, where's going to perform better? Obviously, I'm generalizing. You're not buying Perth. You're buying a particular property in a particular suburb. And you notice throughout all this conversation, we haven't talked about any regional markets. And I'm not going to discount the fact that within Perth, you go down to Rockingham, Mandurah. Within Sydney, you go up to Newcastle, down to Wollongong. Within Brisbane, you go up the sunny coast, down to the Gold Coast. Within Melbourne, you go from the Mornington over to Frankston. You go out towards Ballarat, Bendigo, Shepparton. There's other markets that do work in those areas. We are talking about broader, big pockets of data there. So I'm not suggesting that they are the only markets that you can buy in. But
maybe we should probably do a repeat of this. Talk about regional markets because I know you're an advocate of regional market, like
Absolutely.
Simon Presley's advocate of regional. Maybe I'll put something together, have a good discussion around that. So what's the catch-all of this? So you got 3 years of data, pre and post pandemic, like for like. Some are up a lot, then come down. Some are up a bit, and some really ain't done much at all. So what does it all mean?
There's two big things that I think this means is that as a property investor, you can get caught up in what's happened in the last 12 months, and you get a little bit short-sighted in the sense that why are you buying property? Property should be focused on a 7 to 10 year minimum hold, and we've worked through some examples there of markets that have done phenomenal over the last 10 years. We've also worked through some options where if people bought in Melbourne 3 years ago, they've essentially done nothing, where their opportunity cost was quite large if they just thought, I'll buy what I always know. What it comes down to is, if you're trying to get a return, property is a game of, I refer it to a game of singles if you're talking about cricket. We're not trying to hit a home run off one purchase is going to do all the heavy lifting.
A 6, you've got to get your metaphors right.
Sorry. Yeah, combine that. I've got a North American wife, and I oscillate between a couple of different. I am a cricket fan, by the way. Game of singles. If on the forward, it's cover drive game, really. You're just trying to get eke away at just
I get the point.
Okay, sure.
Home runs are cool.
Dingers.
Batter.
So if we go down to that, I think if we're looking at building portfolios, and that's what we do at Pure Property Investment, we're trying to say, hey, look, we're not trying to buy one property and that's going to solve all of your problems and set you up financially. We're trying to buy a property and actually get some outcomes with that in a 3 to 5 year period of time, look to leverage on that and then go again. Typically build towards anywhere between 3 and 4 assets should do the bulk of the work for the majority of investors. That should happen over usually a 7 to 8 year, 7 to 10 year period of time. To do that, you need to get outcomes within a 3 to 5 year period of time. You can't buy and wait 10 years and then buy and wait 10 years. You simply aren't going to have enough time for the most or majority of people. So I guess the takeaway for me is you need to somewhat be I guess, expansive of the way you think about property and think that it's not always going to perform what has happened in the last 3 years, the next 3 years, next 10 years. And with that, you typically are going to need to broaden your horizons to have a base of properties across a number of markets. They're going to move at different times, provide you with an outcome, recycle that money into the next market, make sure the cash flows are balanced. And it's a pretty simple game. That for me is the major takeaway. But I think the other big one here is to say, don't let the myth of the fact that Sydney and Melbourne, as an example, are the markets that are always going to perform. They will at certain points over the long term, and they won't at certain points over the long term, similar to every single other market. And the data right now is so good because it's so different to what it was 2 years ago or even a year ago, where you basically said, dartboard, throw the dart, you've made 20% in that year. That's what happened for 2 years. It's simply not going to happen, and it hasn't really happened in the past where you get this ubiquitous uplift across every single market in Australia. It simply isn't going to happen again. And that's the big one.
So this is the relationship between data and the ground truth, right? Like, and the two things sort of go hand in glove. The problem with property data is, if I go to CoreLogic, which is the data on smartpropertyinvestment.com.au, it tells me one thing. If I go and look at that data on realestate.com, it tells me different thing. You sit there and just go, oh, sometimes this stuff just doesn't add up, right? So which one do you trust?
That's a good point, Phil, because I think if you're digging into suburbs, that's when the data gets a lot more skewed.
Yeah.
Because the bigger the pool of data, the more you're going to get that average. I think once you go down to Kirribilli as an example, you could look at a 1-bedroom that's looking at another 1-bedroom across the way, and you could get a deep waterfront.
Yeah.
Within the skews of that, you're talking a $500,000 asset to a $20 million asset in the same suburb that get lumped in. Now, if that $20 million suburb transacts in that month, what does it do to that data for that month or that 3-month period of time? It throws it way out of whack. But if you lump Kirribilli into Sydney or even into the local government area, you start to include Mossman, you start to include North Sydney, you start to include a whole range of things, and you're going to get the average. For me, that's the big part, is that if you drill down into a particular suburb over a condensed period of time that has a huge amount of variability, you're not going to get it. If you go into a suburb that is predominantly 10 to 30-year-old established houses, and there's no massive differences of waterfronts, riverfronts, acreage, rezoned land, you are going to get much more rich data that is a lot more accurate. But I think for me, that's the part here, is that you got to zoom out to a point where you got to be comfortable to say that data is going to be pretty accurate. Otherwise, and I guess a hot tip, if you see a market do 50% in a year, something's wrong with the data. It just doesn't happen, unfortunately, unless it is a regional market, or it's a land aggregation, or it's a deep waterfront, or there's only, Birchgrove in Sydney as an example, very, very, very small suburb. And you look at it as a peninsula, you've got waterfronts on each side and a couple of streets that don't have any waterfronts, some water views, and that suburb will transact and show ridiculous. I know I've got assets in Burraneer Bay in southern New South Wales, in southern Sydney rather, again, peninsula. You look at it on any most major fluctuating market of basically any Sydney market, because you can have properties that transact for 2 mil to 20 mil on almost a quarterly basis.
Yeah, so this is how you need to be using data, and there's some smart sort of tips there from Paul. That's good, Paul. Long podcast.
It was.
Sorry for our Instagram live friends. What's your Instagram thing?
Pure_property.
Okay,
yeah.
There you go.
Good old data. We get lots of data updates on that as well.
I'm interested to see how many angry comments there are on this feed right now. We can't watch it live, but no doubt there.
I'm sure I'll share them with the Smart Property Investment Instagram page as and when I dissect them.
All right. Well, maybe we can. But that's Paul Glossop, CEO of Pure Property Investment. Thanks for your time. We'll get you back again. You're back again next month.
I am, mate.
What do you want to talk about?
Well, mate, I think we've got some big things that we're probably going to start thinking about talking about, and maybe dissecting what we just talked about to say, hey, look, let's start to think about how you'd build a portfolio if you were starting now in the wake of high interest rates and crazy property markets, and you were going to say, I'm going to buy my first property, and how do I get that in? And should I even start? And where could I start with a limited deposit? Well, I think we've got some hot tips for you. And
quick headline for our content team: New South Wales election in 2 Saturdays' time.
Yep.
What's going to happen to property?
Sausages at the local primary school.
What's going to happen to property markets? Does it matter? Any difference?
I think the first homeowners grant is still going to the actual stamp duty exemption up to 1.5 mil is still going to be quite a political hot potato, and I think if that expands out to some sort of transition from stamp duty to flat land-based tax, I think it's only really been tempered to get it through in the last 4 or 5 months. I think there's going to be something there that potentially might be more universal, which is obviously the intention long term. That's something that I think might change the landscape for property investors over the next few years.
Okay, all thanks for coming in to the studio. It's good.
Yeah.
Do this in person. And for those of you on the internet watching us on the YouTube or wherever that comes up, thanks for tuning in. It's good to do this visually. I don't know if you prefer us sort of talking and watching us what we're doing. And I can tell you, here's a hot tip for those people. They're my notes that that's a brief that I was given for that podcast. But this is the way we like to keep it raw and organic and uncut. We've covered property data and submarine deals and elections and anyway. Keep your questions coming. Editor at smartpropertyinvestment.com.au. Contact the team there. Anything you want, any questions at all. I probably won't answer them because I'm just but a humble journalist, but I'll find some people to come in and have a yarn about them. So keep doing that. Social media, Smart Property HQ is where you'll find us. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.